You might have seen headlines swirling, maybe even joked about it. Gold hitting $15,000 an ounce. Sounds like a fantasy, right? Well, buckle up, because today we're doing a deep dive into why this isn't just a wild theory for some, but potentially a, very deliberate strategic maneuver for the U.S. government. We're going to unravel a proposed revaluation of America's huge gold reserves. It's an audacious plan, really, that could directly tackle the nation's ballooning debt. We're joined by an expert, a former Swiss banker, who's been making waves with his detailed analysis. He argues the U.S. is poised to monetize its gold, and he's laid out exactly how he believes it could happen.
Yeah, our mission today really is to pull back the curtain on the mechanics of this bold idea.
Yeah.
We need to understand the immense financial pressures driving such a discussion and explore the far-reaching implications for your financial landscape, yes, but also the global economy. What's fascinating here is just the sheer audacity of the plan and the historical precedents it kind of draws upon. It makes it a truly compelling subject.
Absolutely. I mean, imagine just for a moment a single stroke of a pen potentially wiping out trillions in debt. It sounds almost too good to be true, doesn't it? Let's dig in. So to really get why anyone would even seriously consider revaluing gold, we have to face that massive elephant in the room. The U.S. national debt. It's not just big. It's growing at an alarming, almost incomprehensible rate. And the interest payments alone, they're becoming truly staggering. Look, just 3 years ago, the interest expense as a percentage of the government's receipts, basically, the taxes it takes in, was about 8%. Today, it's jumped to 18.6%. That's a huge leap. And the Congressional Budget Office, the CBO, they project it could hit 22.6% for the year after next. It's just this relentless upward trend.
And if we zoom out, look at the broader picture, those CBO numbers, well, they're actually likely too conservative. They're based on interest rate assumptions that, frankly, are currently pretty much unobtainable for a borrower of this scale without causing, significant market disruption. The reality could be even more dire.
Yeah, and to put that in perspective for everyone listening, think about this. A staggering $9 trillion of government debt was issued when interest rates were historically low, like 1% to 2%. Now, as that debt matures, it has to be refinanced, rolled over at today's much higher rates. We're talking closer to 5%.
Right.
So what does this all mean? It creates this unsustainable spiral where more and more of the government's income is just swallowed by debt service, leaving less for everything else. But what if the U.S. holds a powerful yet really underappreciated asset, something sitting right there on its books, vastly undervalued? We're talking about gold. The official statutory price of gold on the U.S. books has been stuck at just $42.22 an ounce for decades.
$42.22?
Yeah, it's a price originally set way back in 1934, only slightly adjusted in the early 70s. It's ancient history in financial terms.
It really begs the question, doesn't it? What's the actual difference between this $42 statutory price and the real market value today? It's enormous.
Yeah.
Take the Federal Reserve, for instance. It holds an $11 billion gold note, which represents gold sold to the Treasury. But that note isn't convertible back to physical gold. Meanwhile, the Treasury's actual physical gold, valued at that same $11 billion on the books, using that old statutory price, is actually worth somewhere between, say, $700 to $800 billion at today's market price. Let's call it around $3,300 to $3,400 an ounce.
Wow.
That's a massive, almost absurd gap between the ledger value and reality.
Okay, now, this sounds like pure financial wizardry, doesn't it? It seems almost impossible. But you've mentioned there are historical precedents and even modern proposals for how this could actually be done. Can you walk us through the mechanics? How would the U.S. government actually pull something like this off?
Certainly. There are ways. One mechanism, for example, was actually outlined in a legislative proposal. It was called the Bitcoin Act, though it didn't pass into law. But the core idea is interesting. It involves the Federal Reserve tendering its low-valued gold certificates back to the Treasury. The Treasury then officially revalues its physical gold holdings to the current market price. Let's use your $3,300 an ounce example. This recognizes a huge surplus value on paper. Then it reissues new certificates, now reflecting that much higher value, back to the Fed. The Fed then effectively pays the Treasury the difference between the old certificate value and the new, much higher one.
Okay, so the cleverness here, the real trick, is that these gold certificates, they are not counted as part of the national debt.
Exactly. That's the crucial point.
So the Treasury effectively gets hundreds of billions of dollars without adding a single dollar to the national debt statistic that everyone watches.
Precisely. It's like creating new funds, not borrowing them. And there's more. Because these gold certificates are perpetual, zero-coupon instruments, which just means they don't pay regular interest and have no maturity date. The government pays no interest on them. And the Fed can't just redeem them for cash unless the Treasury actually decides they want to do that.
So this move, just at current market prices, could immediately free up, what, $750 billion?
Roughly, yes.
Enough to cover about a third of this year's pretty staggering $2 trillion budget deficit?
It's a remarkably clean way, on paper at least, to inject significant cash into the system without appearing to borrow more.
But your analysis goes even further. You suggested a bolder number, $15,000 an ounce. What's the thinking behind that specific target, and what kind of impact would that have on the debt?
Right, the $15,000 figure. Well, at that price per ounce, the revaluation would generate an astounding $3.9 trillion in cash for the Treasury.
$3.9 trillion.
Yes. To put that in perspective, that's roughly 10% of the total national debt, which currently stands around $37 trillion. This kind of sum could allow the Treasury to retire a significant chunk of the debt that's maturing this year and next. High-interest debt, remember. And, get this, it could even allow them to show a profit of $1.9 trillion on the budget for the current year.
A profit on the U.S. budget?
Theoretically, yes, for that year. It would bring the overall debt level down to where it was just a year or two ago. It offers a substantial, albeit temporary, fiscal reset.
Okay, so temporary is the key word there. In the grand scheme of things, this acts more like hitting pause, buying some time, rather than being a permanent fix for the underlying issues.
Exactly. That's crucial to understand. Yeah. It's important to remember this is a temporary respite. It's effectively kicking the can down the road, as they say.
Yeah.
It doesn't solve the fundamental spending versus revenue problems, but it buys crucial time. Time, perhaps, for the government to try and get its house in order.
That's a fair point. But I bet some listeners are thinking, well, hold on. If you're going to revalue it, why stop at $15,000? Why not go all the way? Why not pick, say, $150,000 an ounce and just pay off the entire national debt? I mean, it's a tempting thought, right?
It certainly is tempting on the surface. But that really begs an important question about scale and risk and market absorption. While it sounds appealing, such an extremely high number, $150,000, that would be a truly dangerous strategy. You'd be entering very, very untested waters.
Yeah.
The proposed $15,000 figure is considered potentially absorbable by the global market. It generates a massive sum, yes, $3.9 trillion, but that amount is still smaller than the market capitalization of single companies like Microsoft or NVIDIA.
Right.
This is a huge cash injection, but arguably within what could be considered manageable market parameters, going much higher risks, complete destabilization. You want to avoid that.
Okay, that makes sense. So, beyond the theory and the mechanics, are there any concrete signals, anything suggesting this isn't just a, fascinating thought experiment, but a real possibility? What evidence might point towards this kind of drastic action actually being on the table?
Well, there are whispers, certainly, subtle signs. My analysis, for instance, points to a rather telling comment from former Treasury Secretary Scott Bessent. He said, and I quote, "We plan to monetize the U.S. balance sheet for the benefit of the American people."
Monetize the balance sheet?
Exactly. Now, when you scrutinize the U.S. balance sheet, what's the most undervalued liquid asset the U.S. has? The one most ripe for that kind of monetization? It's undoubtedly gold. This isn't just an isolated comment either. It reflects a broader conversation happening among sophisticated financial players.
That's certainly one way to interpret his comments, a very interesting one. But surely a move of this magnitude would have critics and potentially huge negative consequences. Wouldn't such a dramatic revaluation cause a dollar to collapse? Or maybe unleash rampant inflation, hitting everyday costs for everyone? These are real fears people would have.
They are very valid concerns, absolutely. And we have to look at the historical context, but also the current reality. Back in 1934, when FDR revalued gold by 69% essentially overnight, the dollar did drop significantly, about 51% against other currencies that were still linked to gold then, like the British pound or the French franc.
Right.
But today, the situation is different. The world's major currencies are largely linked to the dollar itself, not directly to gold anymore. So while the dollar might experience some depreciation, maybe weaken a bit, a full-blown collapse is, I would argue, unlikely. The dollar's role is just too embedded globally.
Okay, what about inflation then? The cost of groceries, gas, everything else?
Yeah, retail inflation, that's also not a foregone conclusion. You have to remember where this newly created money goes. It goes directly to the Treasury, and the primary stated purpose would be to reduce borrowing and pay down existing debt. This doesn't necessarily mean flooding the consumer market with new money chasing goods, which is what typically drives up prices in shops.
Ah, see.
In 1934, interestingly, retail prices didn't really change much immediately after the revaluation. What did shift was financial asset anticipation. The stock market moved. The prices of goods in your local shops aren't directly linked to the gold price. They're linked to the supply and demand dynamics of paper money, of dollars.
All right, that's a key distinction. Now, this deep dive wouldn't really be complete if we didn't talk about silver. If gold sees such a dramatic revaluation, potentially to $15,000, what happens to its shiny, often overlooked cousin?
Ah, silver. Yes. If such a revaluation were to happen, let's say gold hits $15,000 and the Treasury effectively becomes a buyer of last resort at that price. People selling gold would suddenly have huge amounts of cash they'd look to diversify. And a lot of that money would likely flow into silver.
And the silver market is much smaller than gold's.
Much smaller, exactly. So that influx of cash would likely accelerate the silver price to a very, very high degree, much more volatile, perhaps. But beyond that specific scenario, silver has a compelling story of its own, even without a major gold revaluation.
Okay, so what makes silver a potential standout then, separate from this gold plan?
What makes silver really interesting is its unique dual role. It's partly a monetary metal, yes, but it's also an absolute indispensable industrial commodity. The Silver Institute, for instance, consistently reports a structural supply and demand deficit. For years now, mine supply is generally declining, or it's stagnant at best. Meanwhile, industrial usage is rapidly increasing. Think electronics, solar panels, electric vehicles, 5G.
See, everywhere.
It really is. This growing structural deficit means more and more recycled silver is needed just to meet demand. And the only way to really suck that needed recycled silver out of existing holdings, out of silverware and old jewelry, is through significantly higher prices. So silver looks likely to go higher, whatever happens with gold, simply based on these fundamental market dynamics.
Yeah.
It's a critical asset to watch.
Okay, these big macroeconomic forces, the sheer audacity of this revaluation idea, it's all creating ripples, maybe even waves in the market already. Let's maybe connect this to some recent events that savvy investors are watching closely, things that might be, well, omens of what's to come, or maybe just indicators of gold's growing significance. Recently, for example, we saw some hotter-than-expected PPI numbers. That's the Producer Price Index, a key inflation gauge, and kind of a jobs debacle in the reports. This led to a former Treasury Secretary actually urging the Fed for a 0.5 percentage point rate cut. Quite a strong call.
And the market responded. The CME FedWatch tool, which tracks probabilities, is now pricing in basically a 100% chance of a rate cut in September. The only question seems to be whether it's a quarter or a half point. Stock markets loved this news, of course. The Dow jumped 400 points, the NASDAQ and S&P 500 hit all-time records again.
Right, but amidst this stock market euphoria, gold actually found itself in a bit of disarray just last week. There was a brief but pretty sharp panic.
That's right, the tariff scare. There was suddenly widespread concern, almost out of nowhere, about a potential 39% tariff being slapped on 100-ounce gold bars. Those are the specific bars the New York COMEX market needs for futures contract delivery. It's different from the big 400-ounce bars typically refined in Switzerland from London good delivery stock.
Exactly. And this scare caused real panic among future shorts on the COMEX. Those are investors betting on falling prices. They suddenly feared they wouldn't be able to get the right bars to deliver if they needed to. It drove up premiums, the extra cost you pay for immediate physical delivery, quite dramatically for a short period.
And then, just as quickly, reports came out clarifying it was all misinformation, no tariffs would apply, positions unwound.
Yes, but the incident, even though brief and based on misinformation, dramatically highlighted just how sensitive the physical gold market is right now, especially to any hint of supply disruption for those specific deliverable bars.
Very telling. And speaking of intriguing details in the physical market, the July COMEX delivery reports dropped something that really caught my eye. Apparently, 12,000 of those 100-ounce gold bars were taken for physical delivery. That's over 3 times the level we saw in July last year.
12,000 bars.
Yeah. Someone or some group with very deep pockets is clearly accumulating physical gold quietly. It definitely hints at bigger players making significant moves behind the scenes.
It really begs the question, who are these mystery buyers? It's all shrouded in secrecy, of course, my assumption. It's likely large players who perhaps foresee physical gold becoming much harder or more expensive to acquire in the near future. Maybe they're hedging against paper assets, paper gold contracts, potentially losing their value or their link to the physical metal.
Who might that be?
My hunch leans towards governments, maybe central banks of countries like Mexico or perhaps some European nations quietly diversifying reserves. Or it could be powerful, very well-connected hedge funds. Funds that might be in the know or at least strongly suspect potential revaluations or other major systemic shifts are coming. Ray Dalio, for instance, founder of Bridgewater, the world's largest hedge fund. He's been very vocal for years about the importance of holding gold in this environment.
Mm.
This suggests that really sophisticated players are actively hedging against a potential paradigm shift in monetary policy.
Well,
A shift where physical assets, particularly gold, could play a renewed, much more prominent role, rather than just being this undervalued entry on a dusty old ledger.
It certainly sounds like the smart money, the really big money, is waking up to the critical importance of physical gold, even if not everyone listening can afford those massive 100-ounce bars.
Yes. And maybe to put this all into a broader context, the government's approach historically has often been to just keep kicking the can down the road on these big fiscal issues. But there's a real danger lurking there. The danger of a black swan event, some unforeseen incident, a crisis, that suddenly exposes the underlying fragility of the whole system. A moment where your conventional money, your savings in the bank, might rapidly lose value, and people suddenly rush to buy anything they think will truly preserve wealth.
So wrapping this up, what does this all mean for you, the listener? We've covered a lot of ground, some pretty radical ideas. While obviously no one should put all their eggs in one basket, our expert here really stresses the importance of diversification. Wouldn't you agree? Things like fiat-denominated bonds, maybe even just cash sitting in the bank or deposits, they face a significant risk of value erosion, whether that happens slowly and gradually through persistent inflation, or potentially all at once in some kind of crisis scenario.
Right, which leads to, I think, an important question for you to consider personally. Do you have even a small amount of physical gold? Maybe at home, somewhere accessible and safe. Not as a speculative gamble hoping the price shoots up tomorrow, but more as an insurance policy, a hedge. It's really about not putting all your financial assets into one type of thing, especially not entirely into the debt or currency of a government that, at some point down the line, might face real challenges in repaying its obligations.
A truly thought-provoking deep dive today. A scenario that, if it played out even partially, could fundamentally reshape our financial world. Keep exploring these ideas, keep questioning, and definitely stay well informed.